There we go. Okay, so the topic that we are going to be covering today is we're looking at discount rates and how discount rates are permitted and used when we are looking at IFRS reporting and IFRS accounting. So what is it that we're going to be covering today? So we're going to cover a bit of an introduction so that we can just get an understanding as to where are discount rates relevant and where are they permitted from a high level perspective. We're then going to go through detail and look at the specific discount rates that are required and permitted in certain standards within IFRS. That's IFRS 13, which deals with fair value, IAS 36, which deals with impairments of your non-financial assets, IAS 37, which deals with provisions, which is a type of liability which you would recognize, and then IAS 19, which deals with employee benefits and a particular type of employee benefit known as a post-employment benefit scheme, being a defined benefit scheme. We're then also going to look at, and the reason why we'll focus on those 4 standards is because the board, the IASB, the International Accounting Standards Board, they embarked on a project a few years ago where they were looking at the discount rates that are allowed and permitted within these different standards. And they were performing a comparison to see, is there consistency or are there inconsistencies into how an entity should go about using a discount rate to measure certain assets and liabilities. So the outcome of their project has not resulted in any changes to any standards at this stage. It was more just for informative purposes. And they will obviously see going forward if it is going to result in there being changes to some of these standards, in particular, the guidance around the discount rates that can or should be used in these circumstances. There's then 2 other standards, being IFRS 16, the new leasing standard, and IFRS 9, which is the financial instrument standard, which also permit for types of interest rates or discount rates to be used in order to do a present value calculation. So IFRS 16 and IFRS 9, the guidance wasn't considered previously by the board. And the guidance within these 2 standards is a little bit different to the guidance contained in the previously 4 mentioned standards. So we'll also just touch on then IFRS 16 and IFRS 9 so that we can all be familiar as to what discount rates are required in those 2 standards. We will then wrap up today's session by going through the IBOR reform phase 2. So I'll go into more detail as to what that is when we get to that section. So as I said to you, the IASB commissioned a project to research discount rates because feedback that they had received over the years suggested that different discount rates are not well understood. So as you will see when we go through the guidance, the standards contain different requirements as to what discount rates should be used and what should be taken into account when determining the appropriate discount rate to be used. And some feedback that the board has received, which encouraged this project, was that the differences in requirements between the different standards leads to inconsistent application. The outcome of their project, which we will see later on in the slides, it was just basically so that there is a reference point for the boards for future standard setting, and so that they've highlighted issues which potentially can or should be addressed in future projects. And there may be some educational material which we may receive from the board at a later date. But just an introduction as to what is it when I'm talking about discount rates and where are they relevant when we're looking at doing our financial reporting in accordance with IFRS. So the conceptual framework identifies the following measurement bases. So a measurement basis is basically the process that a preparer or a reporter is going to apply when they are determining the monetary amounts at which elements within the financial statements should be recognized and carried at the reporting date. So it is the process that a preparer would embark on when they are working out what is the value of a particular asset or a particular liability at the reporting date. So IFRS permits different types of measurement bases. The one is historical cost, and we see historical cost would be used for other types of assets. So for example, if you consider an inventory item. So IAS 2 provides guidance on accounting for inventories. Inventories are measured initially at cost and subsequently at the lower of cost or net realizable value. So historical cost, that would be the relevant measurement base for your inventory items, because the starting point is looking at what was the cost at which the entity incurred in order to obtain that asset. Other assets which you typically see recorded on the basis of historical cost is property, plant, and equipment. So property, plant, and equipment is dealt with in IAS 16, and IAS 16 says you measure your PPE initially at cost. Subsequently, an entity has an accounting policy choice where they can choose to apply what is known as the cost model, or they can apply a revaluation model. If they apply a cost model, that would then indicate that the measurement basis for that item of equipment is historical cost. Because the cost model, the starting point is the day one cost, and subsequently the entity is going to account for depreciation and impairment. If the entity's accounting policy was, however, to apply a revaluation model, that would then indicate that the measurement basis is a current value measurement basis, one in which the asset would be measured based on its fair value. So that is the distinction between historical cost and a current value measurement basis. Current value measurement basis means going and determining at a particular date what is the value of that asset or liability. It is not going to be dictated or influenced by the historical or the day one cost. So current value examples are where assets and liabilities are measured at fair value. If you're determining a recoverable amount by means of a value in use computation, if you're measuring an asset at amortized cost or at its current cost at the reporting date. So you will see that our focal point today is going to be looking at those items that are measured at a current value at the reporting date. And you will see we will cover fair value measurements as well as value in use measurements. So present value techniques, the PV on the slide stands for present value. Present value techniques are used to measure assets and liabilities for financial reporting. And as I said, you see this when there is a measurement basis of current value measurements and amortized cost measurements. As part of a present value measurement technique, there is various inputs that would be required. And that would be as to what are the particular cash flows and the amount, timing, and uncertainty of future cash flows, and what are the discount rates that would be used to translate those cash flows. So this slide is an extract which was taken from the report which was issued by the ISB, when they are indicating when are present value measurement techniques used in current value measurements. So there are cases where it is where it may be the required technique. So in other words, where the standard says that a present value technique needs to be used. And this is for the measurement of provisions in IAS 37, insurance contracts, that would be in accordance with IFRS 4 currently, which is to be replaced by IFRS 17, defined benefit pension obligations in accordance with IAS 19, and if there are significant financing components in an IFRS 15 revenue contract. Where could a present value technique be used as one of the techniques which are available, i.e. it is not the required or prescribed technique, and that is where assets or liabilities are measured at fair value. And where could a current value measurement, present value technique be used as the ceiling, in other words, the maximum amount, and that would be in a value and use computation in accordance with IAS 36. So I will cover that. We will cover most of these as we go through the guidance in today's material. So if we're looking at present value techniques, as I said, the inputs involve cash flows where there could be uncertainty with regards to the amount and the timing. So this is where there could be uncertainty as to the amount of cash the asset will generate or that will be required to settle the liability. And in some cases, there could be uncertainty as to when those cash flows need to be made. So uncertainty can be reflected in present value techniques in a variety of ways, which you will see as we go through the slides in today's session. And the technique which is used by the preparer needs to reflect the uncertainty in a way that is consistent with the measurement basis that is being used. So as I have said, a present value measurement technique is not itself a measurement basis, but rather it is a process or a technique that the entity can apply when they are determining the value of that asset or that liability, determined based in accordance with its measurement basis if it is carried at a current value. There are just some useful concepts. So to wrap up our introduction, just some useful concepts and definitions that we need to just make sure that we are familiar with before we then go through the guidance, just so that we can be happy that when I refer to things such as time value of money, that we all understand what it is that I am referring to. So time value of money is a concept that a sum of money is worth more now than the same sum will be at a future date due to its earnings potential in the interim. So you may find that if I needed to settle an obligation today, I may need $100 in order to settle that obligation. However, given the value of $1 today and what the expected value of $1 or the purchasing power of $1 is to be in, let's say, 6 months' time or 12 months' time, you may find that the number of dollars that I may require to settle the same obligation in 6 months or 12 months may be a different value. And that is why you will see that when we apply discount rates to determine a present value number, we would need to take into account time value of money, because the earning potential and the purchasing power associated to that currency or to that unit of account changes over time. And that therefore needs to be taken into account in present value measurement techniques. Credit risk. This is the possibility of a loss resulting from a borrower's failure to repay a loan or to meet contractual obligations. So for example, if you measure a financial asset in accordance with IFRS 9, if you're determining what is the appropriate discount rate, you may find that credit risk is taken into account, and that is, what is the risk associated to the counterparty? Do they have the ability to pay the cash flows as and when they fall due? So often you would find if you borrowed money from a bank or a financial institution, they will factor in your credit risk when they are determining what is the interest rate that they are going to charge you, because they want to ensure that they are being compensated for the risk that they are being exposed to. And you will see when we go through the guidance that some of the standards require credit risk to be taken into account when determining fair value or determining the present value, whereas other standards are not prescriptive or not clear as to whether or not credit risk should be taken into account. Liquidity, this is the ease at which an asset or security can be converted into cash without affecting its market price. So if you consider your cash and your bank balance, usually we say it is highly liquid because you have the ability to go and access that cash in the short term. You can go and access it immediately. And you know that if you see online, for example, that your balance is $100 this morning or this afternoon, if you went to access that cash a couple of hours later, you would know that there's no risk that there is going to be a significant change in the value of the currency that is sitting in your bank account, given the nature of cash and cash equivalents, that they are said to be highly liquid. Then to distinguish between nominal cash flows and real cash flows. So a nominal cash flow, this refers to the actual amount of money that a company expects to take in or pay out without any adjustment for inflation, whereas real cash flows are adjusted for inflation in order to reflect the changes in the value of money over time. So that was just the introduction. So just to give us a bit of an intro as to why are we looking at, or where do discount rates fit in? They fit in when we are doing present value measurement techniques and where they are permitted at a high level from an IFRS perspective. So now we're going to go through the detail of the slides which are indicated before you currently. So in addition to being aware of where discount rates can be used or are required to be used, we also just need to be cognizant and aware of the disclosure requirements pertaining to present value measurements, as well as where discount rates are used from an IFRS perspective. So this slide is just a very high-level summary of some disclosure requirements that we need to be aware of and to bear in mind when we are doing any present value measurement techniques. So IS1 is the standard which deals with the general preparation and presentation of your financial statements. And IS1 has an overarching disclosure requirement that where there have been significant judgments which have been applied by management in the preparation of the financial statements, those judgments need to be disclosed in the financials. Similarly, if there are any areas of estimation uncertainty, so where perhaps management has had to develop an estimate in order to do their financial reporting, if that is considered to be significant, the inputs and the assumptions which were used by management in developing that estimate, those need to be disclosed in the financial statements. So that is an overarching disclosure requirement from IAS1 with regards to significant judgments and the inputs and the assumptions where there is estimation uncertainty. You do see, however, that as you go through a number of the other other standards also contain specific disclosure requirements around judgments and inputs and assumptions. So if there is an instance where an IFRS standard does not make specific reference to judgments or inputs and assumptions, we would then default back to the overarching disclosure requirements from an IS1 perspective. So therefore, whenever management is applying judgment, which is deemed to be significant, or if they have made any significant estimates which may involve a significant uncertainty, then the inputs and the assumptions which have been used by management, those then need to be disclosed in the financial statements. And that is so that a user can have transparency to understand how did management get to the outcome that they did? Why did they make the decision that they did? What did they take into account when concluding what the value of that asset or liability is, for example? Because you will see that when we are going through the guidance for present value measurements, there are a number of inputs which do require management to apply their judgment, and there are a number of inputs which require management to apply some form of estimation technique. They may need to estimate the future cash flows. They may need to estimate the discount rate. They may need to apply judgment in making certain changes to the discount rate. So you can appreciate that if those judgments or those estimation areas are significant, that the detail around those estimates and those judgments, they need to then be included in the disclosures within the financial statements so that a user can have transparency to understand how that value of that particular asset or liability was determined. You will see in IAS 36, which deals with impairment of assets, and IFRS 13, which deals with fair value. Both of those standards also have extensive disclosure requirements where there is an impairment of an asset or where there has been a fair value measurement for purposes of measuring an asset or a liability. And those disclosure requirements tie back to what I have just discussed, because the board appreciated that in determining whether or not an asset is to be impaired, or when determining the fair value of an asset or liability, there is a significant amount of judgment that management would have applied in determining those conclusions or those measurements, as well as management having to determine the appropriate inputs and and assumptions to be used when doing those present value measurement techniques under IAS 36 and IFRS 13. So both of those standards require the disclosure of what approach has been used by management in determining the fair value, also what valuation method was used, and what are the significant inputs and the assumptions that were used in that measurement, as well as disclosures of the sensitivities thereto. So throughout the slides, we've included some illustrative example disclosures, which we have taken from some of the listed companies listed here locally in South Africa, which can be considered for illustrative purposes, where you can see where these entities are disclosing this information in their financial statements, as is required from the board or in terms of IFRS. Sensitivity disclosures are required because you may find that management may have applied their judgment and concluded on a particular percentage. Somebody in the market may have applied a slightly different adjustment and possibly would have increased or decreased that rate, for example, by, let's say, 0.5%. By disclosing the sensitivities, there is then transparency to the user to understand what would be the impact on that measurement if that particular input were to be the 0.5% higher or 0.5% lower. Because then a user, if they did have a slightly different assumption to that which management used, they can then appreciate and understand what would be the potential impact on the financial statements if that input would be slightly different to that which was used by management in that measurement determination. IAS 19, which deals with employee benefits, also contains certain disclosures and sensitivities, which are then also required to be included in the financial statements. So the first standard that we are going to look at now is we are going to look at IAS 36, which deals with the impairment of assets. And obviously, remember, we are focusing on the present value techniques which can be used when we are looking at impairment of assets and the requirements in particular around the discount rate, which should be used when management is determining whether or not an asset should be impaired. So the general principle of IAS 36 is that an asset should be impaired if the carrying amount exceeds its recoverable amount. So the carrying amount of an asset is basically what is the value of that asset as a result of applying the relevant IFRS standard up to the point or the date at which you are doing this impairment assessment. So for example, if we are looking at the carrying amount of an item of equipment, which is being tested for impairment, we would go and determine what is the carrying amount of the equipment by applying the entity's accounting policy in accordance with IAS 16. They would be applying the cost model because assets subject to the revaluation model under IAS 16 are not subject to impairment in accordance with IAS 36. So equipment in accordance with the cost model, as I mentioned earlier, would be the day one cost less subsequent depreciation and subsequent impairment. That is how an entity would then determine the carrying amount of that item of equipment. That carrying amount then needs to be compared to its recoverable amount. And the recoverable amount is the higher of two values. Higher of fair value less cost to sell, or what is known as the value in use. There was an earlier slide which came up where I said where the board had indicated where the use of a present value technique was where it is used as a ceiling, and that is where they noted that IAS 36, you will use a present value technique to calculate the ceiling being the recoverable amount of the asset in accordance with IAS 36. So IAS 36, in determining the recoverable amount, both of those measurements ultimately could involve a present value technique. Fair value determination is in accordance with IFRS 13, which we will cover later on. And one of the ways in which you can measure fair value is by applying a present value technique. IFRS 13, however, does permit other measurement techniques, a cost approach or a market approach. So not in all instances will a fair value measurement involve a present value computation. Whereas a value in use, so the alternative of your recoverable amount, a value in use number is the number calculated by applying the principles within IAS 36 itself. And the value in use calculation involves looking at future cash flows, which management would need to estimate, which then need to be present valued, i.e. you need to bring them back to determine today's current value with by means of applying an appropriate discount rate. So that is the general principle of IAS 36. If an asset is tested for impairment, you compare the carrying amount to the recoverable amount. The recoverable amount is the higher of two numbers, fair value less cost to sell or value in use. If the recoverable amount is lower than the carrying amount, the difference between the carrying amount and the recoverable amount, that is the amount which is recognized as an impairment loss in profit and loss in the period in which it is determined. So just a bit of recap as to when is an asset required to be tested for impairment. So when is IAS 36 relevant? So just by virtue of having certain assets on your balance sheet, an entity is required to undergo an annual impairment assessment. So just by an entity having goodwill on their balance sheet, or an indefinite life intangible asset, or an intangible asset which is still under development, in other words, it is not complete at year end, just by virtue of having any one of those three assets at the reporting date, an entity is required on an annual basis to test those assets for impairment. In other words, you don't wait for there to be an indicator. Just by virtue of having those assets, an impairment test needs to be conducted. In the case of all other assets, your property, plant, and equipment, your other intangible assets, etc., they are only required to undergo an impairment assessment if there is then an indicator of an impairment. IAS 36 lists some examples of what could be indicators of impairment. Indicators may be external to the entity. For example, there could be changes in the market. There could be changes in legislation. Indicators may also be internal. Perhaps the asset in question is damaged. Perhaps the asset has become idle. Perhaps it's no longer being used to its full capacity. So the list included in the standard of indicators, those are not exhaustive lists. Those are just examples of what could be indicators. There may well be many other things in reality and in practice which could be considered to be indicators of impairment. But what you need to remember is those first three assets: goodwill, intangible assets with an indefinite life, or intangible assets still under development. Those have to undergo an impairment test in accordance with IAS 36 annually, irrespective of whether or not there is an indicator of impairment. In the case of all other assets, and remember here we are focusing on your non-financial assets, in the case of all other assets, you only test for impairment if there is an indicator of impairment. This slide is just, I suppose, a flow chart detailing the process that management or that the entity would go through if they are then performing an impairment assessment. So an impairment assessment, as I have already said, the entity would need to compare the carrying amount to the recoverable amount, and the recoverable amount is the higher of two numbers. If you are determining the fair value less cost to sell, the entity would need to go to IFRS 13 to calculate the fair value, which we are still going to cover just now. They would then take the fair value that they calculate from IFRS 13 and deduct from that fair value any cost that the entity would need to incur in order to sell that asset. That number is then compared to what is known as the value in use, and the higher of those two, as I have said, represents the recoverable amount. So we're now going to just focus on the value in use computation required by IAS 36. So a value in use calculation is a present value measurement technique because it requires the entity to present value the future cash flows which are expected to be derived and incurred by that asset which is being tested for impairment. In a perfect world, an entity should perform an impairment assessment on a per asset basis. That would obviously only be appropriate and available if that asset is capable of generating cash flows on its own. So to the extent that an entity needs to carry out an impairment assessment of an asset, which is not capable of generating cash flows independent of other cash flows generated by the company or the business, then that individual asset would need to be combined with other assets to determine what is the smallest group of assets which is capable of generating independent cash flows. So that is where IAS 36 says impairment assessments may be required to be performed at what is known as a cash generating unit level. So goodwill, for example, is an asset, which goodwill is an intangible asset, but it is not identifiable. So goodwill is not separable from the business itself. Goodwill basically represents an asset, an intangible asset, which cannot separately be identified and recognized on the balance sheet. Goodwill is the byproduct of a business combination transaction. Goodwill can never generate cash flows on its own, but rather goodwill, as part of the acquisition, would need to be allocated to certain assets, which are said to be the assets which would benefit from that business combination transaction. So goodwill is an example of an asset which would have to be allocated to other assets, and you would need to determine the cash generating unit for which goodwill can then be tested for impairment. So a value in use computation can therefore be done for an individual asset or a group of assets known as the cash generating unit. So management, as you can see, step 1 on the slide, would need to work out if they are testing for impairment at an asset level or at a CGU level, being the cash generating unit level. Management would then need to go and estimate the cash flows for that particular asset or group of assets. So this is where IAS 36 is quite prescriptive in that it says what can and cannot be included in those cash flows. But management would need to estimate what cash inflows do they believe they are going to be entitled to from this asset or group of assets. They also need to estimate what are the cash outflows which they are going to need to incur in order to generate those cash inflows. Once they have worked out the cash inflows and outflows, and IAS 36 says that an entity should look at a time period of 5 years. If a different period is used, the entity needs to explain why in their financial statements. But once they've worked out what the cash flows for year 1, year 2, year 3, year 4, and year 5 are, management now obviously needs to apply a discount rate to calculate the present value of all of those cash flows. So they need to take those future cash flows and apply an appropriate rate so that they can calculate what is today's value of those future cash flows. And that is where management is going to need to determine what is the appropriate discount rate, because they then need to work out what is the appropriate discount rate that they must use to calculate the present value, because that present value then represents the value in use. And then you compare that value in use to the fair value less cost to sell. The higher of those two, remember, represents the recoverable amount. If the recoverable amount is less than the carrying amount, the difference between the carrying amount and the recoverable amount, that is what gives rise to an impairment loss. But let's now go through the guidance contained in IAS 36 about how do we determine the appropriate discount rate which needs to be used to present value those cash flows in a value in use computation. So IAS 36 is prescriptive because it says that it must be a pre-tax discount rate. And it says that that discount rate needs to reflect current market assessment of time value of money and risks specific to that asset. So basically, it's the rate which would be used to estimate the rate that the market would expect on an equally risky investment. So if the market had to go and apply a rate to that particular asset or to that group of assets, taking into account the risks specific to that asset or group of assets, what market rate or what rate would the market attribute to that asset or group of assets? So the standard says these rates are usually not available. So often an entity may need to use another rate, another discount rate as a starting point. And then that discount rate should be adjusted to reflect the way that the market would assess that asset or group of assets. So that may require additional factors to be taken into account, to take into account risks that the market may take into account. But also, depending on what that starting point discount rate is, it may be necessary to take out certain elements or aspects which are not relevant to that particular asset or group of assets. So what may an entity use as a starting point for determining the appropriate discount rate? They may look at the company's WACC, which is the weighted average cost of capital, or they may look at the entity's incremental borrowing rate or some other market borrowing rate. But remember, they wouldn't just use those rates as they are. The entity would need to make adjustments to those rates because those rates, the WACC and incremental borrowing rate, for example, would be an entity-wide discount rate. If you are now looking to determine the discount rate, which is for a particular asset or group of assets, it is unlikely that that entity-wide discount rate is going to be an appropriate market rate for a particular asset or group of assets. And that is why if you use one of these rates as a starting point, adjustments are going to need to be made so that you can take into account risks that market participants would take into account pertaining to the particular asset or group of assets, And also you would need to exclude elements within those rates which are not relevant to that asset or group of assets. So this slide is just a diagrammatic, I suppose, illustration of what I've said, how you could start with the WACC or incremental borrowing rate, and you need to adjust for market participants' view of specific risks, which could be country risks, currency risks, price risks, etc., to determine the estimated discount rate, which is then used to present value those cash flows in a value in use computation. So what is seen in practice is that most entities use their weighted average cost of capital as the starting point. So your weighted average cost of capital is a post-tax measure of the overall required return on the entity as a whole. So it is a rate that an entity is expected to pay on average to all of its capital providers. And your capital, what is that? What comprises your capital? That is your equity and the long-term debt. So your weighted average cost of capital basically represents the post-tax rate which the entity pays on average to their equity and on long-term borrowings. And this is where in the determination of your WACC or your weighted average cost of capital, there's the proportionate weighting of the cost of equity and the cost of debt or the cost of your long-term debt. And you weight it proportionately based on the fair value of the debt and the equity components. So this is where an entity would need to go and work out what is the fair value of equity and what is the fair value of their long-term debt. And they would need to determine what is the cost of equity and the cost of debt and weight that proportionately to calculate the weighted average cost of capital. So as I have already said, that weighted average cost of capital could be used as a starting point. And as I've pointed out, that is the average cost of capital for the entity as a whole. And that is why when you're doing an IAS 36 impairment test, the entity would need to adjust the WACC to achieve the discount rate for the particular asset or smaller group of assets, consistent with how a market would view that particular asset or group of assets. For example, if the entity is partially financed through long-term debt, the cost of debt in the WACC calculation would take into account long-term rates, which are payable by the entity on that long-term debt. Therefore, if an entity is wishing to derive a discount rate for an asset which has a short-term expected life, they would obviously need to adjust that discount rate to take into account the fact that the asset's characteristics are short-term, whereas the WACC included the incorporation of long-term discount rates. How would one go about calculating their WACC or their weighted average cost of capital? So a common used method is known as the capital asset pricing model. It's a method of calculating the anticipated investment risks and returns, which are often used to calculate the cost of equity component. Because an entity usually does have the information to calculate the cost of debt component, because you know what is the interest that you are paying to your financiers. It is the cost of equity which an entity may not have. And that is where this capital asset pricing model can be used by an entity to determine what is the cost of equity for purposes of calculating your weighted average cost of capital. So your cost of equity, if you were to apply this method, it takes into account return on an investment that is virtually risk-free. So if there was a risk-free investment, what would be the rate? For example, if somebody had invested in government bonds rather than in the equity of this entity, what would be the risk-free rate that they would be entitled to earn? And then that rate needs to then be adjusted for a market risk premium, taking into account the characteristics and the risks of this particular business. So when you're looking at the risk-free rate, so what is the benchmark rate that you would use? You would go and look for a risk-free government bond rate in the same currency and for the similar duration as that of the cash flows for which you are currently looking at. So if you are looking at, for example, 5-year cash flows for a cash generating unit for purposes of impairment assessment, you would go and look for the starting point being the 5-year risk-free rate government bond rate. And that would be your starting point. And then obviously that would then need to be adjusted for a market risk premium, taking into account the specific risks and characteristics of the business, which is obviously now being considered. Because remember, at this stage, we're just calculating the cost of equity, which then gets added to the cost of debt to calculate the average, to which then you still have to make adjustments for the particular asset. So once you've determined that risk-free rate, it says that there then needs to be adjustments made to it for your market risk premium. And what does that typically then take into account? So you would adjust for what is known as the equity risk premium. So that's the long-term rate of return for equities in excess of that risk-free rate. And so in other words, in excess of that government rate. There would also potentially need to be an adjustment for the particular sector or industry in which the entity operates, because that could be different to the rates obviously available for an entire country or an entire currency. And there could be additional asset or CGU risk premiums which need to be taken into account. So we're not going to go through the detail, because I think for us being, reporting in accordance with IFRS, it's unlikely that we are the ones tasked with having to calculate the cost of equity and then also the WACC. But this is the formula which would be used with an explanation as to what do each of those letters or abbreviations represent. But this is the formula that would be used by an entity to calculate their WACC. So just to recap, WACC is said to be the weighted average cost of capital. So that is where an entity is going to go and calculate proportionately based on the fair value of equity and the fair value of long-term debt. They are going to calculate what is the cost of equity, what is the cost of debt, and proportionately they are going to weight those two rates in order to calculate the weighted average cost of capital. As I said, what is the cost of debt is relatively easy for an entity to determine because they know what interest they are paying on their borrowings. Cost of equity often does require some more work because that requires an entity to go and look at a risk-free rate and then to make certain adjustments for their industry, for their market, etc. And there's just an example on the slide of a computation which an entity has done and the percentages that they took into account, applying this previous formula to calculate what a WACC would have been. And you can see that if they're calculating WACC in two different countries, how the computation could be different because there's different risks which could exist obviously within the different countries. But tying this back to IAS 36 and what it is that we are covering today, we are still looking at your value and use computation to calculate the recoverable amount in accordance with IAS 36 to see whether or not an asset is to be impaired. And I said to you, part of the value and use calculation, you forecast your cash inflows and your cash outflows. Those need to be present valued. The rate used, we said, should take into account the risks and the characteristics specific to that asset or group of assets. The starting point which an entity could use may be their WACC, or it could be the incremental borrowing rate, or it could be another market rate, which the entity then needs to make adjustments to, because those rates are often entity-wide and they're not rates specific to a particular asset or group of assets. So those starting point rates would need to be adjusted to reflect what market participants would take into account when looking at the characteristics or the risks of a particular asset or group of assets. How does one determine the entity's incremental borrowing rate if they wanted to use that as the starting point? So we will touch on incremental borrowing rate later on when we speak about IFRS 16, the new leasing standard. So just the last thing to just consider from an IAS 36 perspective is that IAS 36 is prescriptive and that the discount rate needs to be a pre-tax rate. So you will see then when management is looking at what are the forecast cash flows, they need to be consistent and therefore use pre-tax cash flows. The basis of conclusions to the standard does, however, note that if an entity were to use post-tax cash flows and a post-tax discount rate, they probably are going to achieve the exact same outcome. However, the standard is prescriptive that the cash flows as well as the discount rate need to be pre-tax. Just as a bit of an FYI, just so that you are aware that the way in which impairment assessments are required in accordance with IAS 36 are currently being considered by the board. So we are anticipating that there is going to be an amendment to the requirements of IAS 36 in the not too distant future. Some of the problems which the board is currently looking at in IAS 36 is the requirement that it is very prescriptive, for example, that goodwill must be tested annually, that goodwill doesn't get depreciated. Also that the standard is prescriptive as to what can and can't be taken into account in the cash flows when doing a value and use computation. One of the other things that they are looking at is the requirement that that discount rate has to be a pre-tax discount rate. So at this stage, the board has not finalized what the amendments are going to look like. It is still within the research project phase of the board. So the board is still working on this project. But this slide is currently illustrating where the board is currently and what they are currently thinking when looking at potentially what the changes to the standard would be. And you can see the very last bullet on the slide. One of the things the board is considering is to allow for the use of post-tax cash flows and post-tax discount rates. So the current requirement is that pre-tax cash flows and pre-tax discount rates need to be used. However, going forward, the board may conclude and they may decide that that requirement for the discount rates to be pre-tax may be removed, which could then permit an entity to use post-tax discount rates with post-tax cash flows. So that then wraps up the section on IAS 36, looking at where are discount rates permitted when we are looking at impairment assessments and what the requirements of IAS 36 are in that regard. The next section we're looking at is IAS 37, and in particular, we are going to be looking at provisions and the measurement of provisions. Please feel free if there are any questions at this stage. I see that in the chat box, some of you have obviously greeted each other. If you do have any questions, please feel free to put your questions in that chat box. And as and when I get a chance, I will then obviously debrief those questions. So IAS 37 is a standard which deals with provisions, contingent liabilities, and contingent assets. Contingent liabilities and contingent assets are not recognized as liabilities and assets on the balance sheet, whereas a provision is a type of liability which gets recognized. A liability is defined as a present obligation as a result of past events, the settlement of which is expected to result in an outflow of economic benefits. A provision is said to be an uncertain liability, basically, because it's uncertain as to what is the amount that would need to be paid and what is the timing of that payment. So you can see how a provision could give rise to some form of uncertain or estimation, which is required because management may need to estimate what needs to be paid and when it needs to be paid. In order for a provision to be recognized, there must be a present obligation as a result of past events. It must be probable, i.e. more than 50% likely that the entity is going to have to make a payment to settle that liability. And they should be able to measure that liability reliably. So they must have some way in which they can estimate the value of that liability. A provision obligation may arise as a result of a legal obligation on an entity. So potentially an entity, they may operate in the mining space. They may have a legal obligation which requires them to rehabilitate and to restore the ground or the earth that they are disturbing through their mining process at the end of their life of mine. So there may be a legal requirement on them to incur certain expenditure in the future. Management may not yet know when that expenditure needs to be incurred, nor exactly what is the amount that they are going to need to pay at that later point in time. Obligations could also be constructive. So in other words, the way that the entity has behaved in the past, they may have created a valid expectation that they are going to make particular payments going forward. So for example, an entity may have always paid a bonus to the employees for so long as the entity has been operating, irrespective of the performance of the entity or of the employee. that may have created the valid expectation that they are going to make those payments to the employees, and it is unavoidable. So that is how a provision obligation could arise. So there must have been a past event which took place. It's not contingent or dependent on other things taking place. And it will always involve a third party, whether it's payments, for example, to a contractor who needs to carry out that rehabilitation work for you, or whether it's a payment that you would need to make to an employee, for example. And as I've said, to recognize the provision, it needs to be more than a 50% likelihood that there is going to be the outflow of economic benefits. And in order to recognize it, management must be able to measure it reliably. So this is where the standard, and this is where discount rates become relevant when we are looking at the measurement of your liability provisions, because it may require management to estimate the cash flows, and to the extent that those cash flows may be paid in a future period, they would then be required to present value those cash flows. So IAS 37, like IAS 36, requires that discount rate to be used. So if you, for example, are estimating that you have to make the mine rehabilitation payments in 20 years' time, you would estimate what is the amount that you think you may have to pay in 20 years' time. You then need to present value that to calculate with what is today's value of those costs which you think you are going to need to incur. And IAS 37 says in the discount rate, like IAS 36, it needs to be a pre-tax discount rate, which needs to be used. And this discount rate must also take time value of money into account. In other words, take into account the fact that the purchasing power or the return, the investment return on a particular unit of currency changes today over time. So IAS 37 says the discount rate shall be a pre-tax rate that reflects the current market assessments of the time value of money and the risks specific to that liability. The discount rate shall not reflect risks for which future cash flow estimates have been adjusted. So you can see the only guidance contained in IAS 37 is that a present value computation must be done. It just says it must be pre-tax. It must take time value of money into account, and it should take the risks associated with that liability into account. But the standard is not very prescriptive as to how these things should be factored in or taken into account. These next two slides are just example illustrative disclosures. As I said, we will contain some examples from disclosures we have seen of listed companies here in South Africa. You can see this disclosure has come from their annual financial statements, and it details the rehabilitation provision that they have. It is a mining entity that we extracted this from. And you can see it says the estimate of the provision liability includes costs for the removal of all current mine infrastructure and the rehabilitation of disturbed areas. The period assumed in the calculation of the present value is the aggregate of the construction period and of the life of mine. They also then tell us what is the discount rate that they used, and they started with the government bond rate of 8.75, and then they've given us the comparative amount, the rate that they used. So this is just illustrative disclosure of that information which the entity would have presented in their financial statements around their provisions and the measurement of that provision. This ties back to something I mentioned earlier, that where there has been judgment made by management in determining what period do they think they are going to have to discount these cash flows, when do they think they're going to need to incur those cash flows, and what inputs and assumptions did they make? What discount rate did they use? What did they base it on, etc. So this is how you could see an example of the disclosures which a mining entity could then include in their financial statements around a rehabilitation provision or liability, which they were then required to recognize in accordance with law. So you can see that the guidance contained in IAS 37 around doing an estimate of the provision is somewhat, well, it's a lot less detailed and less prescriptive than the guidance contained in IAS 36, which I explained previously. So some provisions may require the entity to make payments in the next couple of months. If it is a short-term provision, then there would not be a present value computation required. A present value computation would only be required for provisions if that provision is to be paid or if that liability is to be settled beyond 12 months. And that is where the entity then says you need to apply an appropriate discount rate. It must be pre-tax, must take time value of money into account, and risks specific to the liability which you are measuring. There is not much other guidance from an IAS 37 perspective with regards to the discount rates which should be used to measure those liabilities. The next standard that we're looking at, which goes into quite a bit more detail around present value measurement techniques, as well as discount rates, this is IFRS 13. So IFRS 13 is the standard which deals with fair value measurements. So IFRS 13 does not tell you when an asset or liability needs to be measured at fair value. Rather, these other standards indicated in blue on your slide, these are the standards which tell you when something should or could be measured on a fair value basis. These other standards, the ones indicated in blue, do not contain any guidance as to how a fair value measurement should be performed. They rather tell you if and when something can be measured at fair value. If something is then to be measured at fair value, that entity then needs to refer to IFRS 13, because IFRS 13 is the single place within IFRS which now contains the guidance as to how a fair value measurement should be performed. So IFRS 13 tells us how fair value should be determined and what information needs to be disclosed in the financial statements. There are certain assets and liabilities which it may look like they are measured on a fair value basis. However, they are not determined in accordance with IFRS 13. One of the examples, I won't go through all of them on the slide. Let's look at inventory. Inventory, I mentioned earlier, says day one measurement at cost. Subsequently, you measure at the lower of cost or net realizable value. Net realizable value is defined in IAS 2. It is the estimated selling price less estimated costs to complete and costs to sell. Net realizable value may look like a fair value measurement, but it is not dealt with in IFRS 13, but rather it is defined and dealt with in IAS 2. So that is why the items listed on the slide, they may look like fair value measurements, but you don't measure the assets and the liabilities in terms of IFRS 13, but rather the specific standards referred to on the slide, they contain the guidance as to how that value should be determined. So what is fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Ultimately, it is an exit price. So if I have an asset and I'm trying to determine the fair value of the asset, what is the price that somebody would pay me? What is the market price that somebody would pay me to buy that asset from me? So i.e., if I were to sell it, what would be the price that they would pay? Similarly, if I wanted to transfer a liability, what would be the amount that I would need to pay to somebody for them to take over that obligation from me? So the determination of fair value often involves the consideration of some form of hypothetical scenario or hypothetical transaction, where an entity is going to have to go and make certain assumptions about what would a market participant pay for that asset or take in order to, take receipt of a liability. So some fair value measurements may be relatively straightforward because there could be a market price, and that market price we may know is the price at which that asset or liability is going to trade. In other cases, there may not be any directly observable market price for an asset or liability. In those cases, management is going to need to develop this hypothetical scenario to try and estimate what would be the market price. And that is where there may be some unobservable inputs. In other words, inputs which are not available or observable in the market, which management is then going to need to estimate or to develop to ensure that they can achieve some objectivity in the determination of that fair value. because remember, the fair value is ultimately a representation of the market value of that asset or liability. So there are different valuation techniques that IFRS 13 permits. And this is why I said earlier into the introduction into the session is that a fair value measurement does not always have to be determined by means of a present value technique. So discount rates are not required for each and every single fair value measurement. So there are three different ways in which fair value can be determined. There's the market approach, the income approach, or the cost approach. Which approach an entity uses is obviously going to depend on the nature of the underlying asset or liability which is being valued, as well as the information which is available. Because you may find information is available to determine the market value based on a market approach because there is a directly observable price. Whereas you may find in the next year, if there is suddenly no listed market price for that item, you may then not be able to apply a market approach because of the lack of information. And it is possible that the approach which is used may change from one period to the next because of potentially the available information, etc. A change in the valuation approach or the valuation technique is seen as a change in an estimate. And remember, a change in estimate from an IFRS perspective, you apply prospectively. In other words, you would not go back and change the estimates which have been done in the past, but rather just apply the new valuation approach going forward. So what is a market approach? So if an entity was to calculate fair value based on a market approach, this is a valuation technique that uses prices and other information generated by market transactions involving identical or comparable assets or liabilities. So for example, if I had a 2% shareholding in a company who is listed on the New York Stock Exchange, we know that we can go and access online to see what is the current share price for that share. So if my 2% represents 2 shares, we know that I can take my 2 shares multiplied by that share price, which is observable. There's a market price for those shares listed. That would then indicate the fair value of my investment in those 2%, in that 2% shareholding. That is an example of a market approach, where there is a price for the same asset or a similar asset available in the market. An income approach. This is an example of where a present value technique could be applied. So an income approach to determine fair value. This is techniques which convert future amounts. So for example, estimated future cash flows or income or expenditure into a single amount, i.e. a discounted amount. So in other words, you may be looking at future cash inflows and outflows and present valuing them to calculate the single discounted amount of those future amounts. And in the determination of those future cash inflows and outflows, as well as the discount rate, the entity is going to need to take into account market considerations and what market participants would take into account. Because remember, the objective of a fair value measurement is to determine what is the market price of that asset or liability. A cost approach. So if an entity measured fair value by means of the cost approach, this is when they would go and look to see what costs would they need to incur in order to replace the service capacity of that asset. So in other words, if they needed to replace that asset, what cost would they need to incur? And they could use that as an approximation of the fair value of that asset. Also, just to be aware of, I suppose, when we're looking at fair value measurements, is what IFRS 13 refers to as being the fair value hierarchy. So depending on the information or the inputs that have been used by management when determining fair value, that is also then going to indicate where on the hierarchy that fair value measurement sits. The lower down on the hierarchy, you will see that the more disclosure that is then required in the financial statements. A level 1 measurement is said to be where the fair value is calculated based on a quoted price in an active market for the identical asset and liability. So this is usually where a market approach valuation technique has been used. And this comes back to my example of my 2% shareholding in a New York Stock Exchange listed company, where the shares trade on a daily basis. So in other words, we say that those shares trade in an active market. That would be an example of a level 1 measurement. Level 2 measurement, this is where there are inputs, but they are not directly observable to be a level 1. They may be indirectly observable or directly observable for that particular asset or that liability. So in other words, it's still observable in the market. Changes may perhaps need to be made to it because perhaps it's not the identical asset, it's a slightly different asset, but nothing is subjective. Everything is still observable within the market. And a level 3 measurement, this is where management subjectivity has played a role in the determination of that fair value computation. So this is where there are some inputs or assumptions which are considered to be significant, which are unobservable. So if we had to think about a present value technique measurement, if I'm estimating future cash flows and estimating a discount rate, it's unlikely that all of the inputs and the assumptions are directly observable in the market. Management potentially had to make some judgments and make some changes to those cash flows or to that discount rate based on their expectations of what the market would tolerate, etc. So where there are inputs which are not directly or indirectly observable in the market, that would then push the fair value measurement into a level 3 measurement. The difference, as I said, the lower down that you sit, the more disclosure that is then required in the financial statements. So where there has been unobservable inputs used, that would then land up in a level 3, which means there are then extensive disclosures, which I touched on briefly earlier. All of the inputs, the assumptions, the judgments, sensitivities, etc., all of that would then be required to be disclosed in the financial statements. So if we tie what I've spoken about now back to what it is that we're discussing today, being discount rates, where are discount rates relevant from a fair value measurement perspective? And as I said, that is where an entity could be applying an income approach, which may include a present value technique. You may have come across something known as a discounted cash flow computation. So that is where there is then going to be the estimation of future cash flows, which is then going to be discounted to calculate the present value. So there are a lot of similarities between a value in use computation that I spoke about earlier under IAS 36 and a discounted cash flow computation under IFRS 13. There are, however, differences between the two. Although both would involve estimating cash flows and calculating a present value, IAS 36 was very prescriptive for a value in use computation as to what can be taken into account, what can't be taken into account. IFRS 13, you will see, is less prescriptive. Value in use computation under IAS 36 said you should typically look at a 5-year period. IFRS 13 is not prescriptive as to what duration of cash flows you should or shouldn't be looking at. So we cannot just assume that the outcome of a value in use measurement is going to be the same as a discounted cash flow measurement under IFRS 13. So coming back to IFRS 13, a discounted cash flow measurement would discount the estimated future cash flows to a present amount using an appropriate discount rate. So where do you typically see these types of valuation techniques? So maybe if you're looking for fair value less cost to sell for an impairment assessment, financial assets and financial liabilities which do not have quoted prices available for them, investment properties, certain property, plant and equipment measured on a fair value basis, etc. So there's very detailed guidance contained in Appendix B of IFRS 13, which gives us very detailed guidance as to how one could go about doing an income approach valuation in accordance with IFRS 13. So there's a lot of detail as to how would one work out what are the appropriate cash flows that we should take into account, as well as what should be taken into account when we're looking at the discount rate which needs to be used. So the guidance says that the fair value measurement must include the risk-free rate with similar duration as an element of a present value technique. So the present value technique should contain the following principles. Discount rates should reflect assumptions that market participants would make when pricing the item. They should only take into account factors attributable to the asset, and they should reflect assumptions that are consistent with those inherent in the cash flows. and they should be consistent with the underlying economic factors of the currency in which the cash flows are determined. So remember, the objective of a fair value measurement is to determine what would a market participant pay for that asset, or what would be the amount that would need to be incurred in order to transfer a liability. So the objective is to determine an exit price, but ultimately the market price, the fair market price for a particular asset or liability. You will also see that IFRS 13 does not state whether nominal or real cash flows should be used. So should you use those cash flows adjusted for inflation or not? It appreciates that either of them could be used. But remember, there needs to be consistency. If you make certain adjustments in the cash flows, you need to bear that in mind when working out what is the appropriate discount rate, so that you don't double count things in both the cash flows and the discount rate. How could you go about doing a present value measurement to determine fair value? So there's different approaches which could be used. So the one is known as the discount rate adjustment technique, in which an entity would take a discount rate and they would have to make certain adjustments to it and apply that discount rate to the most likely cash flows. Or there is what is known as the expected present value technique, which has two different methods, method 1 and method 2. The first approach is where you don't adjust the discount rate, i.e. you would use the market risk-free rate, but you would make certain adjustments to the cash flows. The second approach is where you don't adjust your cash flows, but rather you adjust the risk-free rate for a risk premium that the market participants may take into account. So we'll just explain what this then means over the next couple of slides. This is also highlighting how IFRS 13 has given us a lot more guidance when it comes to doing a present value measurement in comparison to the other standards I have already spoken about today. So when you're looking at doing a present value technique in accordance with IFRS 13, you need to use the most likely cash flows. When we're looking at the discount rate, so if we're looking in particular at the discount rate adjustment technique, the discount rate will be derived from observed rates, so in other words, market rates for similar assets or comparable assets or liabilities. So in other words, you may start off with a bland generic market interest rate, and then you make certain adjustments to that rate to take into account characteristics of that particular asset or liability. Then you would take those estimated cash flows and you discount them at this adjusted rate of return. So obviously this is going to require the entity to go and analyze market data to determine, are there similar assets or liabilities, you know, the nature of the cash flows of this particular asset, etc., as well as other factors, to make certain adjustments then to that discount rate. So what is an example of how this computation may look? So let's assume asset A promises to pay 800 units in 1 year's time. But in the market, we can also see that there are asset B and asset C, which could be comparable assets. Asset B, however, pays 1,200 units in 1 year's time, and the rate for asset B, which we can see in the market, is 10.8. Asset C, however, pays 700 units in 2 years' time at a rate of 11.2. We're now looking at asset A, which has a life or has a cash flow duration of 1 year only. So because asset B and asset A both have a 1 year cash flow period, the entity may say that asset B is therefore the most comparable asset, and we can see that the rate for asset B is 10.8. So that is where the entity may then say, and a comparable rate for them to then start with is the 10.8 rate. If asset B did not exist, and if the only comparable asset would be asset C, we know that the life of asset C and asset A, the one we are trying to value, are 1 year versus 2 years. We may then be able to start with the 11.2 rate being for the 2 year asset. However, we would need to adjust that rate for the fact that it is a different time duration, that rate of 11.2 is linked to a 2 year instrument and not a 1 year instrument. So this is just illustrating how you could go and identify if there are similar assets or liabilities in the market. If you have the discount rates for those assets and liabilities, those could then be used as a starting point and for purposes of then doing the present value computation for the asset in question. So I said, in alternative to the discount rate measurement technique, there's the expected present value technique, which could be used in accordance with IFRS 13. So this is where the starting point is the set of cash flows that represents the probability weighted average of all future cash flows. So we'll go through an example of what does that mean just now. So this basically means that the entity needs to go and basically forecast what are the different cash flows which they think they could be entitled to associated to this asset or liability. What is the possibility of each of those cash flows then occurring? 10% of this cash flow or 20% of that cash flow, etc. They then need to weight them to calculate what is the probability weighted average of the cash flows. A market participant is then obviously going to take certain things into account or make certain adjustments when they are then looking at the particular value of an asset or liability. So this is where there is then, in order for the present value measurement to be done, a market participant may adjust for different types of risks. There's diversifiable risk, which is your unsystematic risk. This is risk specific to a particular asset or liability, which the market participant may adjust for. Or there's the market risk, which is your systematic risk, which is a common risk shared by the assets or liability within that portfolio. So in other words, just being in part of that market, they're all going to have a particular risk. So as I said, the expected present value technique has two methods which are acceptable in practice. So the first method, this is where the entity would then not adjust the discount rate that they use, but rather they may make adjustments to the cash flows. So remember, the starting point is the weighted average, the probable weighted average cash flows. The entity would then go and make certain adjustments to those cash flows to take into account what market participants would take into account for that particular asset or liability. They then use the risk-free interest rate. So they don't make any adjustments to the discount rate that they use. They will go and obtain a market discount rate and they use that rate as it is. Because in this method, they have adjusted the cash flows, therefore they are not adjusting the discount rate. So an example, let's assume the holder of an asset promising 780 units in 1 year can exchange that asset today for an asset which will give you 758 units at the risk-free rate of 5%. So the entity may then say they're going to adjust their cash flows to represent the 758 and then use the rate, the risk-free rate attached to those cash flows being 5%. The second method, which is the more commonly accepted or seen method when doing present value computations under IFRS 13, is where the entity will go and use the weighted average cash flows, but they then, when they will start with the risk-free rate, i.e. the risk-free market rate, that they then make adjustments to that discount rate to take into account specific characteristics of that asset, of that market, etc. So this is where the weighted average probable cash flows are discounted at a rate that corresponds to an expected rate associated to those cash flows. So cash flows are not adjusted, but the rate would be adjusted in the second method. So the outcome, whether you use method 1 or method 2, it is expected that you should land up at the same valuation at the end. I'm going to go through an example now to explain both again. So I said, when you're doing an expected present value measurement technique, you need to go and determine the weighted average probability of the cash flows. So this requires an entity to then go and estimate what are the cash flows that you think, for example, you're going to be entitled to if you were to sell that asset. So the entity in this case has estimated there's a 15% probability they'll receive 500 units. There's a 60% probability they will receive 800 and a 25% probability that they will receive 900. If you take the value multiplied by that percentage probability, you can then calculate the weighted average probability, which in this case is said to be 780 units. Then remember, there's the two methods. Method 1 says go and make adjustments to the cash flows and then apply a risk-free rate. And method 2 said leave the cash flows, but go and adjust the discount rate. So in method 1, the scenario was on the previous slide, where it's saying that that asset, which could give rise to the 780, the average cash flows, could be exchanged today for an asset of 758 units at a risk-free rate of 5%. So that is why the entity would then use they've changed the cash flows to 758, and they use the risk-free rate of 5%, and they would calculate over 1 year what is the present value. In this case, it is 722. If they applied method 2, this is where they don't make any adjustments to the cash flows, but rather they need to go and make certain adjustments to the discount rate. So we were told that the risk-free rate was 5%, but that there's a risk premium that would be taken into account by market participants, which is 3%. So that means that the entity would use a discount rate of 8%. Present value over 1 year, that gets you to an answer of 722. So you can see that in both method 1 and method 2, the outcome is the same, being a fair value of 722. Which of these two approaches gets used? Which one, whether you should use method 1 or method 2? As I said, there is no hierarchy in the standard. The standard is not prescriptive as to which one is better or worse. But as I've said, you do see more commonly in practice, you do see method 2. So in other words, where the entity will forecast their cash flows, but when looking at what is the appropriate discount rate that they use to calculate the present value, they start with a risk-free rate in the market, and then they make certain adjustments to that risk-free rate to take the specific risks and characteristics of that asset or liability into account to work out what would be the appropriate market rates that a market participant would use to present value those cash flows. So these next few slides just is an illustrative example of disclosures, which you may see in a set of financial statements where an entity is disclosing the information required by IFRS 13. In this instance, we're looking at a valuation of investment property, and you can see they've made specific reference to the discount rate. And then there, in this case, there was a change in the discount rate in a particular period. As I said to you, IFRS 13 is quite prescriptive as to what information needs to be disclosed in the financials. And as I said, IAS 1 contains a similar disclosure requirement that any significant unobservable inputs and assumptions, that information needs to be disclosed. So you can see that for each of the investment properties that have been valued on the left-hand side of the slide, for each of them, the entity has disclosed the range of discount rates which have been used within that particular sector. They've also then given additional detail as to what are the valuation techniques which have been used and the significant unobservable inputs. I did mention to you earlier, and it's not contained on these illustrative disclosure slides, that sensitivities would also need to be disclosed. So in other words, how sensitive are any of those inputs to movements, which could then bring about a change to the valuation, that fair value. I see a question has come through. Can we apply this technique to financial assets loans when testing for impairment? So I'm going to say no, because the expected credit loss model, which is required in accordance with IFRS 9, is specific. The guidance for that is contained specifically within IFRS 9 itself. So although, yes, when you're looking at how do you do your measurement of your expected credit losses, it does require you to go and, estimate future cash flows, etc. When you're comparing your estimated cash flows to your contractual cash flows in IFRS 9, however, you're required to discount at the effective interest rate. So the guidance in IFRS 9 is quite specific as to how you go about measuring your expected credit losses. And the measurement of your expected credit losses does not fall into the scope of IFRS 9. So therefore, measuring impairments under IFRS 9, you would not apply techniques contained in IFRS 13. So the last standard which we're looking at is IAS 19, which looks at employee benefits. So this is when we're still just looking at present value techniques, which the board considered where they picked up there are some inconsistencies, etc. So IS 19 is the standard which deals with employee benefits. There's different types of benefits which an employee could be entitled to associated to their employment contract. So for example, they're entitled to their salary and their wage, etc. That would form part of your short-term benefits. They may also be entitled to a package when they retire. That could be a termination benefit. They could also be entitled to the sabbatical for being there for 10 years. They're entitled to take 6 months leave, or etc. That is a form of other long-term benefit. Where discount rates are relevant in an IS 19 perspective, however, is in the guidance dealing with post-employment benefits. So this is where an employee may be entitled to certain benefits when they are no longer employed by the employer. So it's not benefits payable at the termination of their employment. In other words, it's not something which is payable the date that they leave, but rather they could be entitled to some benefits for years to come. So an example of this, potentially the employer states that they will continue to pay medical expenses for the employee when they, subsequent to their retirement until the date that they then pass away, so when they die. So there's different ways in which these schemes can be put in place. The one is known as a defined contribution scheme, and the other one is known as a defined benefit scheme. A defined contribution scheme is one in which the employer is only on the hook to pay the contribution to the fund. So this is usually where the scheme or the fund is kind of maintained or operated by somebody else on behalf of the employer. So the employer just has to pay the annual contribution, for example, and that is the only obligation which existed on them. If it turns out in years to come that there is insufficient money in that fund, there is no further obligation on the employer. There is no risk to the employer. The fund is obviously then responsible to make that right. The employee cannot go to the employer and say, but hang on, there's now insufficient funds. That is different to a defined benefit scheme, because a defined benefit scheme, this is where the risk lies with the employer. So this is where the employer is responsible to ensure that there is sufficient assets or investment which has been made to ensure that there's going to be sufficient funds available to pay these benefits in future periods. So a defined contribution scheme, as I said, there was no risk on the employer. The employer only had to pay over the contributions on an annual basis, assuming it's paid annually. Defined benefit scheme, this is where there is no separate fund or trust or scheme that's managing this benefit for the employees. Rather, the risk lies with the employer themselves. The employer in that instance would then need to raise the liability for the obligation which they have for these amounts payable to employees in these subsequent periods. They would then also be responsible to ensure that there is sufficient plan assets or investments set aside, which would then be used to settle those obligations in future periods. So I'll be honest, locally in South Africa, we do not see defined benefit schemes often. And the reason why is because they place risks on the employers, and also because they are complicated to actually account for. Because the entity needs to go and measure what is the fair value of this liability, what is the market value of this liability, as well as they need to go and measure the fair value of the assets which they should have to actually settle those obligations in future periods. So where does the accounting get complicated for a defined benefit scheme? So it gets complicated because management is then going to have to make certain assumptions and estimation, etc., around what they think is going to happen in the future. So for example, how old do they think that employees are going to live until before they pass away? So what are the mortality rates? If they're retiring at the age of 65 and they're expected to pass away at 70, therefore we're looking at payments which we may have to make for 10 or for 5 years. So there's estimation around when do we think that the average person is going to pass away, i.e. for how long do we need to actually make these payments? Also, how many employees do we think are going to retire? What do we think that they're going to claim, etc.? Are they going to become disabled and their expenses could increase, for example? So there's certain demographic assumptions as well as financial assumptions which the employer is going to make. So what is, if they're looking at this kitty of assets or investments which they have on the side, which will be used to settle these obligations, what is the expected rate of return? If they're looking at the obligations that they need to pay, what is the appropriate discount rate that they should be using to calculate the value of the liability, etc. So there's a large amount of inputs and assumptions which an entity is then going to have to make in order to measure both these assets and these liabilities for these, this benefit they're giving to the employees after their employment. So there's, as I said, they're going to have to recognize a liability. They're going to have to recognize an asset. They're also then going to have current income and expenditure, which is going to go through profit and loss, linked to the current service cost in the period, as well as interest income or expense, which could have been generated on the assets or liabilities, as well as some other gains and losses, which may be recognized in other comprehensive income. Because without us going through the detail of IFRS 19 accounting, you will see that in measuring those liabilities and those assets, there's certain portions of those measurements which the standard requires to not go through profit and loss, but to rather go through other comprehensive income into equity. So at this point, I'm just highlighting how IFRS 19 accounting is quite complicated for employers who have defined benefit schemes, this being one of the reasons why we don't see these schemes too often in practice anymore. But if we're now looking at where discount rates are relevant, so if we did have an employer who had a defined benefit scheme, how are discount rates taken into account? So this example, which is included on the slide, I have taken directly from the standard itself. So if we just had to think about how an employer would go and measure such a liability, they're obviously going to have to go and forecast for the future periods what is the amount that they think they're going to have to pay out to these ex-employees who are now making claims on them for their medical benefits, for example. So they're estimating what are the amounts that they think that they need to pay. Do they think there's going to be increases in the years to come? How many years do they think they're going to have to make all these payments, etc.? So they would obviously go and map out what are the expected cash flows. They then need to apply a discount rate to calculate the present value of that liability. And that is where they are then going to have to look at everything that they expect that they are going to need to pay for so long as the scheme is in place until it expires. They need to then calculate the present value of those cash flows to represent the liability, which they then need to recognize. So IAS 19 states that that discount rate must take time value of money into account. It's also interesting because IAS 19 says that there is no adjustment for credit risk. So in other words, you're not going to adjust that discount rate for a risk that you may typically take into account when measuring the present value of other types of liabilities. There's also some guidance in IAS 19 as to what is the appropriate starting point for your discount rate. So previously, the standard used to say, when you're trying to work out the appropriate discount rate to use, you should use the market rates on high quality corporate bonds. So in other words, that must be your starting point, your corporate bond rate. And IAS 19 said that where a country does not have high quality bonds, then the government bonds must be used. This created a problem when in the Eurozone, because you can see that previously it was referring to, let me go back to the previous slide, specific countries. But if you looked, for example, at the Eurozone, they all have the euro currency. So if you're in Greece or Germany or Portugal, there is no country-specific high-quality corporate bond that could be used. Then the question was, what should those entities within the Eurozone, what rates should they be using? So this is where they amended IAS 19 to say you must go and look at the high-quality corporate bonds. And if there is no high-quality corporate bond, it now says go and look at the currency and then use the government bond for that particular currency. So that now, for example, if they all have the same currency being the euro, they can then go and look at the Eurozone currency bonds as an approximation of the starting point for that discount rate. So that basically was the only guidance that IAS 19 contained with regards to what discount rate should be used. So they said that you should take time value of money into account, but they did say that you should not adjust for credit risk. The next few slides just illustrate some examples of disclosures which we have seen in financial statements. These were extracted from PricewaterhouseCoopers from their available, which is readily available online, their illustrative disclosures. You can just see how as I've said again, significant inputs and assumptions, how they are then required to be disclosed. And you can see how discount rate is required to be disclosed. This is also then an example of how the sensitivities could be disclosed. And as I've mentioned, sensitivities should be included for IAS 36 as well as for IFRS 13. If that discount rate had to increase by a certain percentage or decrease by a certain percentage, what would be the impact on that liability in this case? So that is so a user can see how sensitive the value of the asset or liability is to changes in these discount rates, which management has had to apply judgment to determine what is the appropriate discount rate. Perfect. So that basically brings an end to our detailed session on IFRS 13, IAS 36, IAS 19, and IAS 37. I'm not sure if in previous sessions they did give you a comfort break. Could somebody just indicate to me whether we should take a few minutes as a comfort break or if we should continue on to the rest of the session? Okay, I will wait for somebody to respond. If they can just let me know if we should take a short break or if we should continue. But what I will do is I will continue going through the presentation.
Okay, so can we just take a two question in the QA section?
Okay, I'll respond to that. But can you let me know if we should take a break or not?
I think we should. Let's just
okay. I'll respond to the question and then we can take a short comfort break.
So how much time you need them to break? I can just put on the...
We can take a 10-minute comfort break, but let me just go through the question and then we can take a break.
Okay, sure.
So the question that came through, should we use the contractual cash flow or discounted cash for purposes of classifying between current and non-current? So remember, at the end of the day, when you sum your current and non-current, it needs to represent the present value of that liability. So the sum of what you're disclosing as current and non-current needs to represent the actual balance at the end of your reporting period. So you would then need to work out, if you've got an amortization table where you're showing, what is capital installments, what is interest installments, etc., you should then be able to work out what is the appropriate amount to be classified as current versus the amount to be classified as non-current. So you would measure your total liability, applying your present value techniques. You would then need to work out what is the appropriate portion that's payable in the next 12 months versus what is the portion payable beyond that. So let me just respond to the second question then. Can we use the present value technique, discounted cash flow under IFRS 13 to do value and use for an asset? So that's a very, very good question which you have asked, because as I said, a value and use computation under IAS 36 looks very similar to a discounted cash flow computation under IFRS 13. Although they're similar, there are differences between the two. And as I said, when we went through IAS 36 is prescriptive as to what can and can't be taken into account in a value and use computation. So, for example, it says you should use a period of 5 years. It tells you what you can, what you can't take into account, in your cash flows. Must be a pre-tax discount rate, etc. Whereas IFRS 13 is not as prescriptive as is IAS 36. So you could do a discounted cash flow for a longer period. You're not restricted like IAS 36 as to what you can and can't take into account, etc., when looking at your cash flows. So although the approaches seem similar, a DCF under IFRS 13 is different to a value and use computation. So although an entity would be required to calculate fair value less cost to sell and value and use, the outcome could be different if they did value in use under IAS 36 and a discounted cash flow under IFRS 13. I think let us take a break now for a comfort break. If we just take a 10-minute comfort break, I will then address any other questions when we regroup after the comfort break and then go through the rest of the session. Okay, so we'll take a comfort break now for 10 minutes. Hi, everyone. I realize I apologize. I forgot to state what is the specific time that we will start again. So it has been 10 minutes. So I am able to carry on. There was another question that came in just before the break, that in Cambodia, there is no government bond. So what is your suggestion for risk-free rate? So I have been doing some research now then during the break, just to try and see what the answer to that question would be. And there was an interpretation which was done by the IFRIC in 2017, where they say that if you don't limit the assessment to the market or country in which the entity operates, but also considers other markets or countries in which high quality corporate bonds determined or denominated in that currency are issued. So you would go and look to see potentially if there are other markets in which there are bonds which may be issued in your currency, to go and see if they can be used as a proxy. I'm quite happy to say that I can take this question back and just investigate it a little bit more, because I think the next question may then be, what if there are no other markets which issue bonds in that currency? And I cannot, unfortunately, at this stage, see what the response to that question would be. So I'm happy to take that question back, and then I can coordinate with who we've been dealing with to coordinate the session to get an appropriate response if that is in fact the case. Then I see another question as to what is the logic behind pre-tax and post-tax discount rates. So I may be wrong in saying this to say that there is no logic, but what the board has always planned is that there should be consistency between the cash flows and the rate. So in other words, if you are including taxes in your cash flows, you should then use a rate which takes that into account. Similarly, if you're excluding taxes from your cash flows, your rate should then exclude the impact of taxes on that discount rate. So that was more the logic behind it, was them being prescriptive that you need to be consistent in both the cash flows and the tax rate. Whether one is better than the other, what we've seen in practice is that entities often don't actually have the information to do pre-tax cash flows or pre-tax discount rates. The information to do things on a post-tax basis is often what is in fact available. So entities are having to almost use post-tax information to adjust for it to get back to pre-tax numbers, just in order to comply with the standard. And this is obviously something that they have picked up as part of this work that they have done, that there are these inconsistencies. And why, as I mentioned, potentially one of the changes to IS 36 is that they are no longer going to be prescriptive, that a pre-tax rate and a pre-tax cash flow in fact needs to be used. So if we look now at what was the outcome of the project that the board embarked on, they did identify and note that there are inconsistencies between the guidance contained in these standards, as I have just explained, as to what is required in a discount rate and what should be taken into account. And they picked up that these inconsistencies arise in specifying either which types of inputs should be used in a present value technique and how the inputs should be determined. So the next couple of slides, I'm just highlighting the differences that the board did pick up. And as I said, unfortunately, at this stage, we don't have an answer as to what are they planning to doing with these differences. As I said, it was potentially now going to form part of potentially a future project that they would embark on, or an educational document which they may issue. But just to recap the standards that I have spoken about already today, what items are measured. So fair value measurement in accordance with IFRS 13 could be for any the fair value of any asset or liability as is required from any other IFRS standard. IS 36, we looked at your non-financial assets when they are tested for impairment, and in particular, looking at the value and use computation. IS 37, the measurement of provisions, required a present value of the future expected cash outflows. And IS 19, which dealt with employee benefits, we've spoken about the present value of those future amounts payable to employees for defined benefit obligations. Are these standards that I've spoken about explicit as to what measurement basis needs to be used? So IFRS 13 prescribes the different approaches, what could be used. IAS 36 tells you what a value in use is. IAS 37 isn't really so clear. It just says you need to do some form of present value. And IAS 19 isn't clear. It just kind of says there needs to be this present value of the future cash flows expected to be paid. So as I've said, only IFRS 13 and IAS 36 are really clear as to how this measurement gets done. Both IAS 37 and IAS 19 are not as clear as to how this present value computation gets done. Are these standards all clear with regards to the inputs that should be used? And I think if you just reflect on the amount of time that I spent on IFRS 13 and IAS 36, you probably agree that there's a lot more guidance in those two standards as to what gets taken into account from a cash flow perspective. So when estimating the cash flows, as well as what adjustments need to be made when looking at what is the discount rate. So both IAS 37 for provisions and IAS 19 for employee benefits, they're not as clear as to the inputs which need to be used in a computation. All of them do have one thing in common though, and that every single one of those standards requires for the discount rate to take time value of money into account. Should the discount rates take into account a risk premium? So in other words, make certain adjustments for risks specific to a particular asset or liability. Both IFRS 13 for fair value and IAS 36 for impairments stated that risk premium should be taken into account. IAS 37 looking at provisions didn't say so, but in practice we see that preparers do that. And IAS 19 for employee benefits does not take into account any risk premium adjustments on a liability. Should we take into account liquidity? In other words, the ability, the access to funds and the ability to make these payments. Fair value measurements and impairment, one of the things we would take into account is liquidity. The other two standards, again, it's unclear as to whether or not this should be taken into account. Should we be using pre-tax or post-tax discount rates? So IFRS 13, fair value, it's not prescriptive. It just says in IFRS 13, you should be consistent. IAS 36, they were prescriptive. They said it should be pre-tax. But as I said, this is something that they are currently looking at as to whether or not they should remove that requirement. And then both IAS 37 for provisions and IAS 19 also required pre-tax discount rates to be used. So you can see again there in response to the question which came through that there's inconsistencies, and also we know that they're potentially going to change it for IAS 36. Unclear at this stage if they're going to change that requirement for the other two standards as well. Should we be using real or nominal cash flows? In other words, should we look at cash flows that have been adjusted for inflation or not? And you can see that 3 of these standards are actually not prescriptive. Obviously, again, remember, we need to be just consistent. If you are taking an adjustment for inflation and the cash flows, make sure you don't double count for it in the discount rate. But IAS 19 with employee benefits is the only standard which actually made it clear that we should be using nominal cash flows. So you can see again there that there is diversity within the standards. What information needs to be disclosed? So this is just a bit of a summary slide. I did mention to you at the beginning that IAS 36 and IFRS 13 are both quite prescriptive as to what needs to be disclosed. The others are not so clear as to what information is required to be presented in the financial statements. So these again, the next few slides are just summaries again of the board's findings, again just highlighting some of the differences between the two standards. I have covered some of these already on the previous slides. These slides are just showing the actual extracts from the board's paper. And then where things get disclosed, is it profit and loss or is it other comprehensive income? So the feedback from this project, which the board carried out to just have a look at the guidance required where discount rates are or present value is permitted. Sorry, I see somebody saying that the slides are small. You do have access to all the materials. So the detail is contained in the materials which you do have access to. The board has now acknowledged that there are differences in the requirements and the guidance across the standards. At this stage, like I said, we are not sure what the board is going to do with this feedback. They do believe that it will be used to address inconsistencies, and they will address them in projects going forward. But as I said, at this stage, it is still not clear as to how they are going to take this feedback into account. What the outcome basically did just illustrate to us is that in certain standards, there is a lot more guidance and it is a lot more prescriptive than it is in other standards. And I suppose for us as preparers, you just need to make sure that you are conscious of what standard are you looking at to make sure that you're taking the correct information into account then when looking at the cash flows as well as the discount rates. And like the question asked, can I do discounted cash flows for value and use? And as my answer indicated, the requirements of the standards are different. So you're just going to have to make sure, depending on the present value measurement that you are doing, why are you doing it, which standard are you in, and make sure that you're taking the correct information then into account when doing these present value measurement techniques. So I did say to you that there were then two standards, IFRS 16 dealing with leases and IFRS 9 for financial instruments, which also make reference to the use of discount rates, but for very different purposes, when compared to what I have explained up to now. So IFRS 16 is the new leasing standard. So IFRS 16 requires a lessee to now recognize a lease liability and a right of use assets. There are some exceptions to that, etc., that obviously I'm not going to cover into today's session. What we're looking at, though, in particular, is how does that lease liability get measured, and what are the rates that a lessee should be using when measuring that lease liability. So in measuring a lease liability, the standard says the lessee must recognize the liability at the present value of the lease payments at commencement date. In other words, the date at which the lessee has the right to control the use of the asset. They need to recognize the liability and the right of use asset. How do you measure the liability? In essence, you need to present value the payments that the lessee is still obliged to make to the lessor over the lease term. So it's also an example of a present value measurement technique. IFRS 16 requires that the discount rate that is used should be the rate implicit in the lease. So the implicit rate is the rate that at the commencement date discounts all of the lease payments as well as the residual value of the asset to determine or to get back to the fair value of the asset on day one. So for those of you who are familiar with working with a financial calculator, you may have a situation where you need to solve for I, i.e. determine the interest rate. If you're now determining an interest rate, you need to know what present value is. So present value would be the fair value of the asset on day one. Future value would be what is the residual value guarantee, if any, in this lease arrangement. Payment would be what are the rentals payable by the lessee to the lessor. The term would be what is your lease term. So if you have all of those inputs, you can solve for I, being the rate implicit in the lease. That is then the discount rate that the lessee should use to present value all those payments payable to a lessor. This is an example of how that can be determined. Let's assume lessor B enters into a lease of a motor vehicle. It's a 5-year term. The fair value of the vehicle on day one is 10,000. And B expects the fair value, the residual value guarantee at the end of the term, to be 1,000. Rentals are 2,000 per annum. And B incurs initial direct costs of 500. So to calculate the rate implicit in the lease, we need to know what is present value on day one. Present value on day one would be the fair value of 10,000 plus the initial costs which the lessor needs to incur, being the 500. What is the term? It's 5 years. What are the payments? It's the 2,000 per annum. What is my future value? It's the 1,000 at the end of the term. So we can then calculate, this is basically the formula that your financial calculator would do to solve for I. So we know present value is 10,500. We know what the next 5 payments are. We know what the value at the end of the term is. we can then solve for I. If we solved for I, we would have determined a rate of 1.48. The problem is that the determination of the implicit interest rate assumes that the lessee has all of this information. A lessee may not have the information. They may not know what is the residual value at the end of the term. They may not know what is the fair value on day one. They may not know what is the initial costs that the lessor incurred on day one. So therefore, there could be cases where a lessee is not able to determine the rate implicit in the lease, because often they don't have access to the information, and it is unlikely that a lessor would give the lessee that information. So this is why the standard says that if you do not have or you cannot calculate the rate implicit in the lease, then the lessee has to use the incremental borrowing rate. The incremental borrowing rate is ultimately if that lessee had to go and obtain funding in the market for a similar amount on similar terms with similar payment profile, etc., what would be the rate that they would be charged? So incremental borrowing rate is basically a forward-looking rate. So if we had to go and obtain new funding today for a similar amount, for a similar duration as the lease term, etc., what would be the rate that we would be charged? That is then the discount rate that a lessee needs to use to present value their lease payments in the absence of the rate implicit in the lease. So these two rates are actually quite fundamentally different, because the rate implicit in the lease is a rate which is specific to the lessor, whereas the incremental borrowing rate is a rate specific to the lessee. So remember, the standard says you should use the rate implicit in the lease to the extent that you have it. If you do not have it, then the lessee must calculate their incremental borrowing rate, which must be used. So as I said, the incremental borrowing rate, it's a lease-specific rate that should take into account the terms and the conditions of the lease, because you need to go and determine what rate would the lessee be charged if they borrowed money for the similar value as the right of use asset for a similar term, the same economic environment, etc. So that rate should take similar characteristics into account, as does the lease contract. So the board says that the lessee may use some other rate as a starting point. So they may start with some market-related rate, for example. They would then need to make adjustments to that rate to obviously get to a rate which approximates the rate that they would be charged if they were to incur additional borrowing at commencement date of the lease. So I'm now going to take you through an example as to how one could calculate an incremental borrowing rate. And this methodology is actually the methodology that we've applied at W Consulting when our clients request us to help them calculate an incremental borrowing rate. Let's assume that the lessee is a South African company. They've entered into a 3-year lease for office space. They need to calculate their incremental borrowing rate. So they've engaged an expert, let's assume it's us, to calculate this rate for them. Other information that we have from their statement of profit and loss is their interest expense and their earnings before interest and tax amount. So the approach that we follow, we identify certain key factors which are relevant in determining an incremental borrowing rate. What is the term, i.e. the duration of this funding? The economic environment, what is the currency of the environment? Is there any security that is given or collateral? And what the lessee pays in order to borrow. So what payments are made over this duration or over the term? Because the incremental borrowing rate is said to be made up of a benchmark rate, i.e. you will start with a rate, and then certain adjustments need to be made to it, which we refer to as being the credit spread. The benchmark rate is influenced by the economic environment and the lease term, and the spread is then driven by the other factors. So you will see that the benchmark rate, i.e. the starting point, is going to be a rate taking into account the currency and the economic environment, as well as the duration of the borrowing. Then there would need to be adjustments over and above made to that benchmark rate. So what we would do is, because there is information available in the USD market, it is not necessarily available for all other markets around the world. We may start with a USD starting point. And if we determine a rate in USD, we would need to then obviously convert it into our currency. Because in my example, the lessee was a South African entity, and their functional currency would be the South African ZAR. So we would need to, if we did a determination of a rate in a foreign currency, it would need to be determined or converted into the currency of the reporting entity. So this is the formula on the left-hand slide, basically, which we would use in order to calculate incremental borrowing rate. We would start with the risk-free rate. We then need to make adjustments for credit spread and for country risk premium. And then we need to convert that rate into the local currency. So what is credit spread? So remember, I said you start with a benchmark rate, and then you make an adjustment for credit spread. So credit spread is based on publicly available spreads that takes into account the level of indebtedness, profitability of the lessee, and the fact that the borrowing is secured if it is. They're usually only available in the US market. So this is why we typically start with the determination of a rate in the US denomination, and then we would convert it because we have access to the information in US. So the interest rate coverage ratio at the measurement date, the information per the management accounts, we know that this was available in our scenario. So we can calculate what is the interest rate coverage ratio. So that's by looking at what is the earnings before tax and the interest expense. We can see what is the coverage ratio. With the information that is available in the US markets, that means we can see what is the rating of this particular entity. And as a result, we can then also see what is the market credit spread for an entity with that type of rating. So we're now told, based on the information we have access to, that the implied credit spread for this type of company is 0.75. But remember, going back to this slide, our starting point is going to be a risk-free rate adjusted for credit spread and adjusted for country risk premium. The country risk premium, this you would need to, how you determine this, it's by comparing the benchmark rate in the one country against that of another country. So in our case, because we're looking at a 3-year lease term, we would need to go and compare the country risk premium in South Africa versus the country risk premium in the States. Because if our starting point is now to measure a US rate, we need to obviously go and work out what is the adjustment denominated in the US numbers rather than in the South African numbers. So we would have information as to the South African risk-free rate, the US risk-free rate. We then also know what is the South African inflation and the US inflation. So we now would need to take the South African risk-free rate and we need to convert that into an US equivalent, because we now need to work out what is the country risk premium, what is the differential between the risk-free rate in South Africa and the risk-free rate in the States. And we can then convert our South African risk-free rate to the States or the American equivalent by basically adjusting for the differences in the inflation between the two countries. So if we take our South African rate of 8%, almost convert that into an American equivalent by adjusting for inflation between the two countries, we can convert that the converted USD equivalent is 5.96. The risk-free rate in the States was 1.42. The equivalent South African risk-free rate is 5.96, which we've calculated. Therefore, we can see that the country risk premium is 4.54. So how do we calculate now the IBR in the foreign currency? It's the US risk-free rate of 1.42, the credit spread, which we calculated, of 0.75, and the country risk premium of 4.52. So we would say the US IBR that we've calculated is 6.71. We need to convert that by the adjustments in the inflation again to get it to a South African equivalent. That is how we would then calculate that the local incremental borrowing rate is 8.76. So if I go back to this slide can be used as a starting point for one to then calculate an incremental borrowing rate. As I said, because the information is readily available in the US, we often do the determination on a US basis and then convert it to the local currency of the lessee entity. What you need to watch out for when you're doing a lease accounting and you need to calculate an IBR to be used by the lessee to measure the lease liability. As I said, the IBR is a lessee and a lease specific rate. So you cannot, for example, go and say that every single lease contract the lessee entered into will all have the same rate. If one lease is 2 years and the next lease is 10 years and the next one is 15 years, chances are the rates that entity would be charged if they took a 2-year borrowing or a 10-year borrowing or a 15-year borrowing would be different. So for the same reasons, your incremental borrowing rate would be different for those 3 leases. Also, you cannot just assume that a subsidiary's IBR is going to be the same as the as the parent's IBR. So the rate that a subsidiary may be charged could be different to the rate that a parent could be charged. To the extent, however, that the parent acts as the treasury function and possibly they basically act as the financier for the group, there may be cases where it could be appropriate to use the parent's IBR, but that would obviously depend on the facts and the circumstances. IFRS 16 requires in certain cases a lease liability to be remeasured. So there may be things which take place in subsequent periods where there could be a renegotiation of terms between the lessee and the lessor. So potentially the lease term changes. They change it from a 5-year to a 10-year lease. Or the lessee wasn't going to buy the asset, now they believe they'll buy the asset at the end of the term. So IFRS 16 is quite clear in that depending on what is changed, it may be necessary for the lessee to update the incremental borrowing rate which they use. There may be cases where there may be changes to the liability, however, the lessee must continue to use the same initial incremental borrowing rate. So if there is a modification in accordance with IFRS 16, there are cases where the standard is clear and it says the new modified lease must be treated as a new lease, which means then that the new incremental borrowing rate at that date needs to be used to measure that new lease liability. If the modification does not give rise to a new lease, it could result in the remeasurement of the existing lease, in which case a revised discount rate would also then need to be used. So this is to just point out that once a lessee has determined the incremental borrowing rate, if there are certain changes in that lease arrangement subsequently, and the standard is clear which changes trigger that modification guidance, there would then need to be an updated IBR determined. So the entity would then need to go through the same exercise of calculating what is the incremental borrowing rate to remeasure that liability. So that's just as an FYI, that don't just assume once you've calculated IBR on day one that's done. There may be cases where the rate may need to be revised and the same exercise would then need to be carried out. So we're now just going to look at what are the discount rates which are applied in IAS 9 accounting. So looking at financial instruments, and then we will wrap up the session looking at the IBOR reform phase 2. So I see a question has, however, come through. Legal requirement imposed on a reporting entity to pay the employee based on the number of years of employment work in the past, and the payment is made over a period of 5 years. Would that requirement fall under IAS 19 or IAS 37? So if it is in relation to services which are being rendered by that employee, you could fall into the scope of IAS 19. But you would see that the measurement consequences of IAS 19 would be the same as that of IAS 37. If it is, however, with regards to some other arrangement and the reason why the employee could be getting that payment, it is, in other words, it's not linked to their services, then it may fall into the scope of IAS 37. But you will see that that measurement, because we're now not looking in that complicated post-employment obligation guidance that I spoke about earlier, whether you're in IAS 19 or IAS 37 for this particular liability, you will see that the measurement of that liability is likely going to be the same. So the starting point would be to go and understand if the payment is linked to services rendered. If it's linked to services rendered, you would go to see where you fall into from an IAS 19 perspective. Question is, should we revive the IBR for a lease amount that we already determined in previous periods? No. So once you've done your initial accounting and you've initially recorded your lease liability and your right of use asset, let's say your lease was in 2020, you then unwind interest on that liability using the original rate that you used. You only revise the rate if there is a modification in the terms. And the standard is very prescriptive as to what gives rise to a modification. So if you change the lease term, if you change the amounts that are payable by the lessee, that could trigger a modification, and it would be in those instances that you would then need to update the discount rate. But if the lease is just carrying on as it was intended in the beginning, you do not revise your discount rate. You will continue to apply the original discount rate to calculate the interest that gets recognized on that liability. So I see the question on discounting for lease payments. Instead of using incremental borrowing rate, can you use some other rate? And the answer is no. So the standard is prescriptive. You must use the rate implicit in the lease if you have it. If you do not have it, then you must use the incremental borrowing rate. So there may be different ways in which an entity could calculate the incremental borrowing rate. I went through our methodology, which has been accepted. Different methodologies may say use a different starting point, but you need to make adjustments to whatever your starting point is, because that rate needs to take into account characteristics of that lease arrangement. But that's why I say the standard is clear. It must be the rate implicit in the lease or the incremental borrowing rate. Cash flow in the lease, that should this be part of the cash flows that in the implicit rate calculation? So I'm not sure what that question is saying. If you're asking what cash flow should be taken into account, you would look at what is payable to the lessor. If you're, obviously you're going to need to then work out what is the amount payable. If there's additional taxes which are payable, if you are obliged to make those payments, yes, you would need to incorporate them into your lease liability computation. It's going to depend, I think, on your requirements and your tax requirements locally, etc. So I do want to just hold on to, I don't want to give a definitive response in that case, because I'm not 100% sure of your local requirements when it comes to VAT and withholding tax, etc. But the principle of the standard is that you would need to look at what is payable to the lessor. If something is payable, but in essence it's payable to a third party, you would then need to work out, should that be recognized as a separate liability or not? It is going to come down to what your legal requirements are from a VAT and a tax perspective, unfortunately. Okay, so let's come back to discount rates from an IFRS 9 perspective. So IFRS 9, where does interest rates become relevant? So they could be relevant when we're looking at the measurement of both our financial assets or our financial liabilities, those who are measured at amortized cost in particular. So financial assets under IFRS 9, there are three ways in which a financial asset can be categorized. So if we're only looking at your debt type of financial assets, so your trade receivables, your loan receivables, etc., they can either be measured at amortized cost, at fair value through profit and loss, or fair value through other comprehensive income. When I'm now talking about present value measurements in terms of IFRS 9, I'm going to be looking at those measured at amortized cost and those actually measured at fair value through other comprehensive income. If a financial asset or a financial liability is measured at fair value through profit and loss, you're going to measure the fair value in accordance with IFRS 13, which I spoke about previously. If a financial asset is measured at fair value through other comprehensive income, the fair value is also going to be determined in accordance with IFRS 13, which I spoke about earlier. The issue with a fair value through other comprehensive income instrument is that there could be some movements during the year which are still required by the standard to be recognized in profit and loss. It is then the difference between what has been recognized in profit and loss and the fair value, which then gets recognized as a fair value movement in other comprehensive income. So without going through all the detailed guidance again of IFRS 9, your fair value through other comprehensive income financial assets that are debt type financial assets, for example, trade receivables, which could be classified into that category, they are still required to have certain movements as if they were measured at amortized cost to go through the statement of profit and loss. So when I speak now about amortized cost measurements, this is impacting financial assets and financial liabilities classified at amortized cost, as well as your financial assets, debt type financial assets, classified at fair value through other comprehensive income. So there are two types of rates which an entity would need to take into account when looking at amortized cost measurements. There is something known as the coupon rate, and then something known as the effective interest rate. The coupon rate, I always say, think of the letter C and think of cash flow statement. The coupon rate is going to drive the cash flows which are payable or receivable attached to that instrument. The bank, for example, may require you to pay 10% per annum interest. So that would be the coupon rate, because that's going to drive the cash interest that you need to pay to the bank. Whereas the effective interest rate, that is the rate which is going to influence what gets recorded in your statement of profit and loss and other comprehensive income. So the effective interest rate and the coupon rate could be two different things. Coupon rate impacts cash flows, whereas the effective interest rate impacts the unwinding of interest on that instrument and what gets processed in your profit and loss. So the coupon rate is usually quite clear because it is usually stated by the borrower what the rate is that's being charged. The effective interest rate an entity may need to calculate. Again, it would be similar to solve for I on your financial calculator. So it's the rate that an entity discounts the estimated future cash flows over the expected life to its initial recognized amount. So IFRS 9 says all financial instruments are measured initially at fair value, and your amortized cost instruments are measured at fair value plus transaction costs. So if you now need to calculate your effective interest rate, take your financial calculator. Present value would be your fair value plus transaction costs on day one. Your term would be whatever the expected life of the instrument is. Future value may be zero, assuming it's settled to zero. It may have a value depending on the facts and circumstances. You can then solve for I. That would be your effective interest rate. So it takes into account the expected cash flows by considering the contractual terms, and you ignore expected credit losses when you are measuring your effective interest rate. So let's consider an example. Graham acquired a 3-year 10% bond on the 1st of April 2014 with its nominal value of being $100,000. It was issued at a discount of $5,000 and transaction costs were 1.2. The bond is repayable at a premium at maturity. This scenario gave us the effective interest rate, but I can tell you that if you wanted to calculate it, you would be able to calculate the 12.18. The day one value is the nominal amount of 100,000 plus the transaction costs of 1,200 less the discount. So that would be our present value. Our term, it's a 3-year bond. So we know that the term is 3 years. What are the payments which are payable? So we know that we have to make interest payments of 10% over the 3-year period. And at the end of the period, we have to pay the amount owing, being the 100,000 plus a premium of 2,000. So we know what is our payments over the period, and we know what is the future value. If we solved for I, we would get to 12.18. So this is basically, if you wanted to do the computation yourself, you would be able to calculate the solve for I, which is now also, if you wanted to demonstrate your amortization table, that's what it would look like. Because we had the opening value of the 96,200, we know what the closing value is, 102. We know what payments are payable based on the coupon rate, which is the 10%. So we know what amounts are payable throughout the period. And that is how we could have solved for I. So this is also demonstrating how your effective interest and your coupon interest are two different amounts. The coupon interest is the 10% that the financier is charging based on the nominal amount, which you have to pay annually. It influences your cash flows. Whereas your effective interest rate, this is the rate which is then going to be used to present value, that future value, to get to your fair value. That is the rate which is then going to be used to unwind interest on that financial instrument over the life. Your effective interest rate gets recorded in your statement of profit and loss. So that is to just differentiate between the two rates which are basically provided for from an IFRS 9 perspective. So that then wraps up the guidance that we are going to address today, dealing with interest rates which are permitted or required to be used from an IFRS perspective. We've looked at interest rates for impairment, IAS 36. We've looked at interest rates for fair value, if you're doing a present value technique. We've looked at discount rates for post-employment benefit obligations, if there is a defined benefit scheme under IAS 19. And discount rates under IAS 37 for provisions. We then also spoke about what interest rates are to be used for lessee accounting under IFRS 16, as well as the interest rates which are to be used for IFRS 9 measurement of financial instruments at amortized cost. So the last thing that we're just going to touch on today's session is the IBOR reform, and in particular, IBOR reform phase 2. So for a bit of background, what is IBOR? What is this IBOR reform and why is it relevant? So IBOR, it stands for an interbank offered rate. This is a benchmark interest rate at which major global banks lend to one another in the international interbank market. So if a South African Reserve Bank, for example, wanted to interact with your local national bank, this would be a proxy for the rate that they would potentially transact at. So it's a rate which is used between the international banks. Where it's become relevant is you find that many institutions now actually use these IBOR rates as the starting point to determine other rates which influence their accounting. So for example, an entity may say, we are going to lend money to you. However, we are going to use the London interbank rate. We're going to use the LIBOR rate, and then we're going to adjust that for your credit risk and for time value of money. So that IBOR rate has been used often as a starting point to determine a lending rate between parties who are not international banks. The problem is that these rates have been questioned over the last number of years. And some have said, do these rates actually reflect the cost of financing between these international banks? Because there has been argument that these rates have been manipulated to just achieve particular rates between particular parties at certain intervals. So they are subject to the risk of manipulation by the banks. And also, as I have said, some have argued that they do not, in fact, actually represent the cost of funding. So are these rates then appropriate rates that should be used as benchmark rates or as starting points for other institutions or other entities to then determine interest rates, which should take into account, in theory, the cost of funding adjusted for other aspects? So in 2018, because there was uncertainty around these IBOR rates, because the banks were now looking to say that potentially we shouldn't be using these rates, the ISB was a bit concerned about the uncertainty because they know that there are so many financial instruments which entities and preparers around the world are using, which have been measured, linked somehow to one of these IBOR rates. Because they know that these rates will potentially be amended and replaced with some other form of risk-free rate. So, for example, the other rates which are being considered is the secured overnight financing rate in the States, in Europe, the Euro short-term rate, in the United Kingdom, the sterling overnight rate. So we can see that now lately, a lot of these IBOR rates are now being not utilized, but rather they are now being replaced by other risk-free rates. So this then obviously, as I said, gave some concern to the board because they were aware that there are so many financial instruments and derivatives and hedging relationships, etc., which exist in practice, which are pegged to these eyeball rates. And that if these eyeball rates now fall away, what is that going to mean for all of these entities who need to do financial reporting? Because our standards already have certain guidance that says, if the rate is renegotiated between the parties, you need to do ABC. This is how it needs to be accounted for. And the board was, and in particular with hedging, it could result in that hedging relationship not being effective. You cannot apply hedging, so if these rates were to just suddenly change, that could bring about quite a problem for a number of reporters who are applying a number of different accounting standards because of the specific requirements that those standards actually already take into account or require. So the board embarked on a project to deal with these uncertainties because when they first started the project in 2018, at that point, we did not know what was going to happen. They then broke the project into 2 phases. And the first phase, which was issued in 2019, basically just said preparers can carry on doing what they were doing on the assumption that there will be no change. So in other words, we don't yet know what the changes are going to be. We don't yet know what the outcome is going to be. So just kind of pretend that there will be no change and carry on doing whatever you were doing. Because in that phase, the board was then working on phase 2, where they were then going to introduce how entities should then deal with these changes now that we know what is actually going to take place. So in April 2020, the exposure draft for phase 2 was released and the final amendments were issued in August 2020. So eyeball reform phase 2 became effective from 1 January 2021. So what this phase 2 basically allows, or what it is going to result in, is it's going to say that the preparers can be exempt from having to apply the normal requirements of certain IFRS standards. So as I said, these standards, IFRS 9, which deals with financial instruments, IFRS 4 for insurance, IFRS 16 for leases, they contained guidance already that said, should certain things change, such as interest rates, etc., this is how it needs to be accounted for. And in many cases, it is going to give rise to modifications, which could result in significant amounts having to be recognized in the statement of profit and loss in the period in which these changes occurred. So it could become quite cumbersome on a reporter if suddenly the underlying interest rates were to be amended just as a result of, the international banks saying they're going to scrap these eyeball rates. So the phase 2 amendments as part of this eyeball reform is now giving relief to preparers to say that they don't have to apply the normal requirements of these standards if there has been a change which has impacted them as a result of these eyeball rates now being replaced by other discount rates. So who is likely to be affected? Most likely it's going to be the financial institutions because they are usually the entities who are using eyeball rates, but also there could be other preparers out there who are using eyeball rates as a basis for their funding or their hedging relationships. So they could then also be affected as a result of the changes in these eyeball rates. So as I said, where there has been changes in these eyeball rates, the preparers are being given some practical expedience or some relief where they could be exempt then from having to apply the normal requirements of those standards, which would typically be required should something such as the discount rate or the interest rate between parties change. But they are only going to be available to a preparer provided that this is the only thing that has changed. If there is any other change, so in other words, if the financier is not just changing the interest rate, but he's also going to change the term at the same time, then they cannot rely on the expedient which has been issued as part of the eyeball reform phase 2. If the only change in the instrument is the interest rate, then they can rely on these practical expedients which have been issued as part of the eyeball reform phase 2. So under IFRS 9, there is already guidance in IFRS 9 that says if there is a substantial modification, in the terms between the lender and the borrower, since that instrument was entered into. That is then going to give rise to a release or derecognition of the original instrument and the recognition of the brand new second instrument. So if, for example, just by replacing the LIBOR rate with a risk-free rate, if it gives rise to what is defined as being a substantial modification, that means that the original asset or liability must be derecognized. Let's say it's a liability that I owe money to the bank. As a result of a change in the interest rate, it's resulting in a substantial modification. The standard says that is if it is more than a 10% change in the value. That means that entire liability needs to be released to the income statement. So let's say it's a $10 million liability. I'm going to go debit liability, credit income statement, a gain of $10 million. I then need to recognize the brand new liability on the new terms. Let's assume its value is now 9 million. I'm going to go credit liability and debit my income statement. So where there is a substantial modification, there is a gross recognition and derecognition of the old and the new instrument, which will then have a significant impact on the statement of profit and loss from a disclosure perspective. If a modification is not substantial, you can just remeasure the liability, calculate the net, and take it to P&L. So this relief, as a result of IBOR reform phase 2, says a preparer doesn't need to go through that exercise. They don't need to go and do this gross recognition and derecognition, etc. But rather they can just update their effective interest rate for the changes in these rates. But they can only do so provided that the only change in terms between the parties is only as a result of this benchmark, this LIBOR reform. Any other change means that they cannot consider this expedient. They're going to have to go and apply the normal requirements of IFRS 9. The same in the case of IFRS 4. So IFRS 4 is the old insurance standard. It is being replaced by IFRS 17. IFRS 17 is only effective in 2023. So preparers were allowed to be exempt from applying IFRS 9 until such time as they apply IFRS 17. It then says for those insurance companies who are applying this exemption, they can continue to apply IAS 39, the old financial instrument standard. The same practical expedient I just explained for financial instruments is then also available to those insurers. Then lastly, how is a lessee affected by this reform phase 2? So I mentioned earlier when I spoke about incremental borrowing rates in IFRS 16, in that if there is a modification of the lease at a subsequent date, it could require an updated discount rate to then be used to measure the liability and adjust the asset. If the only reason why there is a change in the discount rate is a result of the IBOR reform, there is then a practical expedient available to the lessee where they would not need to update their discount rate. They don't have to follow the normal modification guidance under IFRS 16. So, sorry, if the rental payments changed, as a result of the IBOR reform, that would require a revised incremental borrowing rate. They're saying in this case, they can just update the discount rate, as a result of IBOR reform, to work out what would be the net impact on their discount rate, rather than having to apply the normal requirements of IFRS 16. But again, this is only going to be if the only change which has occurred is as a result of IBOR reform. If there is any other change to the lease terms or the lease arrangement, then they cannot rely on this relief in terms of the IBOR reform. So the IBOR reform, as I said, the second phase, it has now been specific as to what do preparers do from an IFRS 9, IFRS 4, IFRS 16 perspective. And basically it gives relief to those parties to say they could be exempt from having to do the normal consequences or the normal requirements and envisaged in those standards. And they can do something alternative, which will make their life easier when accounting for the changes in these underlying rates. We locally, I must be honest, we don't see too many entities who are going to be affected by IBOR reform. I'm not saying there are none. There are definitely some entities who would be affected, but on the whole, it's usually your financial institutions who are affected, not too many of our other clients are being effective. And obviously just within your jurisdiction and your industry, it may be different. You may have some entities who obviously may be more impacted than others, some who potentially are not impacted at all. So I appreciate that then wraps up the guidance for today's session. I can see that there are some other questions which I will address now. And please, if you do have any other questions, can you put them through on the Q&A section, and then I can debrief those before we wrap up today's session. So I see how to calculate your effective interest rate when the loan has 10% in year 1, 11 in year 2, and 12 from year 3. So if you're saying that the bank is saying we will charge you 10% in year 1, 11% in year 2, that just changes your cash flow. So let me flip back to a slide where I can then demonstrate to you how that would impact. So if your rate, for example, was not fixed at 10% per year, you're saying the cash flows in year 1 are 10%, in year 2 it's 11%, in year 3 it's 12%, etc. That means if you're solving for I on your financial calculator, your payments for each period change. There's an ability on your financial calculator to put in different payments if they are different in each period. It would be the same if you're doing a manual computation. Your coupon interest would change in year 2 and year 3, etc. Which means when you're solving for I, you're going to then determine a different effective interest rate. So the formulas you would use, etc., are still the same, but you would see because your coupon rate changes, it is going to have an impact on the determination of your effective interest rate. You would still apply the same process to calculate what that effective interest rate would be. And next question, how to determine the effective interest rate when the bank offers the loan based on its funding cost plus margin percentage and subject to reset every year. So there is specific guidance within IFRS 9 which deals with these where there could be an interest rate that resets. There are certain cases in which you just pick it up as an update in the rate each year. I'm unfortunately not 100% familiar with exactly how that resetting in the interest rate works. I'm also happy to take note of that question and I can get back to you with more specifics, but there is specific guidance in IFRS 9 which deals with these rates which could reset on an annual basis. And then how do you determine the effective interest rate for a 3-year loan charging interest at LIBOR plus 3%? So this is where there could be uncertainty. Remember, if you don't have a fixed, I don't know, because you're saying obviously in that case, it's a variable linked instrument. Guidance in IFRS 9 would obviously say that you're going to go and, for purpose of calculating the value of a liability or an asset, you're going to have to go and estimate your future cash flows. So you would take into account, based on what you know, what are the amounts that are going to be payable in future periods. You'd be using your LIBOR rate as at today plus 3%. But you appreciate that that value and that liability or instrument could change in future periods to the extent that the LIBOR rate changes in a subsequent reporting period. Are there any other questions then which any of you have which I can then address before we close out today's session? Okay, so that then brings an end to today's session on discount rates and how discount rates play a role in financial reporting from an IFRS perspective. From my side, I do just want to say thank you to you for the questions that you've asked. I do appreciate, I need to just come back to you as to what happens if there is no government bond rate for Cambodia and there aren't any other jurisdictions who are issuing bonds in the currency. I'll also then just copy the guidance from IFRS 9 dealing with interest rates which reset on an annual basis. But other than that, that is everything from my side, and thank you very much. I will get those responses through to the coordinator who we've been dealing with in the past, and they should be in a position to distribute those responses to you.
Okay, thank you very much, Bridget. Okay,
thank
so
you.
Anyone? No more question?
Yeah, I don't see any more questions.
Okay, thank you very much. Okay, we will have the attendant and we will export it from this this Google Meet, and then we will send everyone an email so that everyone can confirm the name to be appear on the certificate. Okay, and right, so I think this is it today. We have done a
Perfect.
great job. And
Thank you very much.
okay, in the name of okay, Casey today he's attending the graduation ceremony. That's why he cannot come here.
Okay, no
And
problem.
we would like
Thank
to
you very
thank you
much.
very much, Bridget, for your time and your contribution to our attendance
Pleasure.
today. We will learn
Pleasure.
and we learn a lot from your session today.
Brilliant. Thank you.
Thank you very much, and thank you everyone for your
Bye.
participation and your your time with us today. And we will see you next time.
Cheers. Bye.
Bye bye, Bridget. Bye bye. I'll see you later. Okay.